Intaro adun Tassadar. The Zerg fleet is attacking. We must ask the Terrans for assistance to defeat this menace.
Welcome back to Strongman Personal Finance. If you know what I'm talking about, then you're probably old and crusty, just like me. That's right, I'm talking about StarCraft Brood War, the best real-time strategy game ever freaking made. By far, leaps and bounds above any other strategy game. To this day. That's right, that game came out in 1998, and I still play it. And it's near and dear to my heart. Now, who published this amazing game? With the Protoss and the Terrans and the Zergs? Blizzard Entertainment, which is now called Activision Blizzard. We need to have a look at this stock, because apparently there's been some trouble brewing with Blizzard. Going on Everything Money Software, it looks like over the past year the stock has dipped pretty significantly. Looking on Robinhood, to be exact, it's dropped 30% this year. And basically all the losses have been over the last 3 months. Why? Well, let's go look. Activision Blizzard shares dropped after reports CEO allegedly knew about misconduct. I don't know if I can say that word. I can say bussy, but I can't say that because YouTube doesn't know what bussy means. Activision Blizzard shares closed following allegations that the CEO, Bob Kotick, knew about sexual misconduct allegations. All right? Kotick failed to inform the board of directors about the allegations, including an alleged grape, the Wall Street Journal reported Tuesday. The news comes as the video game company faces a series of investigations over its workplace practices, including how it handled allegations of misconduct and discrimination. So apparently there's some bad stuff going on at Blizzard. But you got to ask yourself, I know it's horrible, but you got to ask yourself, is this a long-term problem that's going to destroy this company? Or is this an opportunity to buy the dip? I think it's a temporary setback, and I think the stock price will probably recover. However, I don't think it's a great buy if you want to get a high return. However, you will get some kind of return over the long run if you buy this stock. It's all about what return you want. So looking at some of the metrics, we have a market cap of $45 billion. I mean, that's boring. Why not just buy Tesla? They have $1 trillion. Net income's $2.6 billion over the last 12 months. Profit margin, 30%. That's pretty freaking high. And gross profit, pretty freaking high, 72%. Price to sales is 5. I mean, that's kind of high, but, it is a faster growing company than a lot of other companies out there. Now, if we go and see what Blizzard's all about, we can go look at the 10K, which is boring. Or we can go see some pretty colors, okay? We can go look at some games. Now, I don't know if you recognize some of these games, but Diablo. I actually never liked Diablo. World of Warcraft. I actually never got into that because I didn't really have internet in my room when I was a kid. It was annoying. Warcraft 3. Played the crap out of that game. And StarCraft. Look at this. Oh, my heart. My heart. Oh, I love it. I can't get over it. Yes, I freaking love this company, okay? Now, what else do they have? Let's go shopping. If it actually loads. Is it going to load? No. All right, we'll go to the 10K. So, if we read some of their segments, they have Activision Publishing, which delivers content through premium and free-to-play offerings and primarily generates revenue from full game and in-game sales. Activision's key product is Call of Duty. Oh, have you heard of that? A first-person action franchise. I used to play Call of Duty all the time. I used to be really good at Modern Warfare 2. Blizzard delivers content through premium and free-to-play offerings. Blah, 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 blah. World of Warcraft, Diablo, Overwatch, StarCraft. I mean, holy crap. And then they have King Digital. And that is Candy Crush. Wow, man, they got some serious long-term players. So when it comes to staying power, this freaking company isn't going anywhere, okay? So if you believe in this company and you're worried about these sexual, I said it. The harassment, misconduct, it's a temporary problem with the stock. However, I don't think it's a good buy right now. Now, let's go do some fundamental analysis, okay? So we learned what the stock's all about. It's a gaming company. Very solid brands that are near and dear to my heart. And I want this stock to be a buy. I want to buy this stock, okay? I love it. However, it's not a good deal if you want a 15% return. So let's go look at some of the numbers. So what I did is I was actually able to find something on Morningstar that I actually can copy and paste into my model. I did make my own model because I am cheap, and eventually I just want to use it all myself. So it's kind of weird because when they copied it over, they put gross profit at the top. So you can see gross profit over the years from 2011 to the last 12 months. And their gross profit has been improving. I mean, they've gone up to 72%. It's pretty freaking good, okay? The next row is revenue growth. So let's see what we've had for revenue growth over the last couple of years. Okay, so going back to 2012, year over year, 2, -5, -3, 5, 41, 6, 6, -13, 24, and 11. So they've had some ups, and they've had some serious downs. I guess the industry is cyclical. I guess if they release a new release, oh my god, StarCraft 5, their revenue would probably spike again. But on average, going forward, in my humble opinion, I don't think it's going to grow more than 11%. Okay, as companies become more mature, they tend to slow down in growth. And looking at the general expected compounded annual growth of, the gaming industry, it's about 9%. So in my middle assumption, I said, okay, they grow the same speed as the gaming industry. Low assumption, they grow slower than the gaming industry at 7%, or they grow faster at 11%. Share change. So share change matters because your portion of a company's earnings is all determined on how many shares there are outstanding in the company. So if the company buys back shares, the company's profit gets split over fewer shares. It's called treasury stock. And if they issue shares, that dilutes the shareholders. So if we go look at share change, they are slowly diluting, very, very slowly. So over the past couple of years, they've issued about 0.5% shares per year. And they actually had this massive buyback of shares in 2014. I don't know what that was about, but they did it. So anyway, over the last couple of years, it's been a very slow dilution. So in my model, I assumed, okay, maybe they just keep doing what they're doing. 0.5% per year going forward, or they stop, or they even start buying some shares back. It's possible, okay? They have pretty high free cash flow as a percentage of sales. They could definitely buy shares back. Profit margin, I said 22 to 28%. Why? Well, let's go look, okay? Net income available to common stockholders. That's you if you buy this stock. Now, over the last couple of years, it's been 24, 23, 27, 29. So they've been improving their profit margins every year for the last 3 years, which is pretty freaking good, okay? So I said, okay, maybe that last year is a fluke. Because if you look back, I mean, they're approaching 30, but it might not get there. So I said, just to be safe, 22, 25, 28. I mean, you can change it if you want. Free cash flow is a percentage of revenues. I don't think they had free cash flow on here, which was freaking annoying. So I had to go look at everything monies. But I was able to determine that roughly 25 to 31% is a rough free cash flow margin. PE, I said between 10 and 14. It's a faster growing company, but in 5 years, which this model's based on, I mean, I don't think it's going to be that high of a PE. And their PE right now, and this is right now, not 5 years in the future, is 17. So think about it, okay? It's probably going to be lower, especially with this crazy, stupid market. And then I said 15% return, 15% return, 50% return. And look at the freaking prices, okay? It's currently trading at 58 after this freaking crash. Now, if you believe these high assumptions, 11% revenue growth, profit margin, and this is I think this is kind of reasonable. I mean, I think they could grow potentially at 11%. It is a buy right now to get a 15% return if you think all of these are going to come true. However, if you like to play it safe and you like to go with the middle assumptions, assuming the company basically grows at the speed of the gaming industry, it's a buy between $39 and $43, which it's 58 right now, so it's not a buy. And then the low assumptions, holy crap, not even close. Now, if you wanted let's say a 7% return, okay, it's a buy. If you want a 7% return. If you want a 2% return, oh, it's definitely a buy. I mean, look at that, 2%, bro. I mean, you can buy at whatever price you want, but it's going to determine what your return is going forward. You don't want a 2% return, okay? If you're going to get 2% return, you might as well just buy the freaking market and get whatever, 10 or 6 or whatever the market's going to freaking perform going into the future. So right now, it's maybe, possibly, potentially a buy. I would wait till it drops more. If it got down into the 40s, I'd really start looking at it. But right now, I mean, it's a little too rich for my tastes. Even though I love that StarCraft. Okay, let's go look at StarCraft again. So amazing. So delicious. Brood War. If you don't know what this game is, just leave my channel. It's not even popping up. What the heck? Anyway, whatever. So that's it. So, yes, I think this is temporary. Yes, I think this company could give you 15% returns if they perform. But for me, I want to wait a little bit. If it drops in the 40s, I'll reconsider buying this stock. That's it. Like, subscribe, tell your friends about me. And y'all have a wonderful day. Cheers!